Where will the smart money go in 2023? One of the best ways to secure your financial future is to invest. And one of the best ways to invest is over the long term. It may have been tempting over the past few years to deviate from a long-term approach and chase quick returns. But it's more important than ever to focus on investing for the long haul while sticking to your game plan. Investors today have many ways to invest their money and can choose the level of risk that they're willing to take to meet their needs. You can opt for very safe options such as a certificate of deposit, CD, or dial up the risk and the potential return with investments such as stocks, mutual funds, or ETFs. In fact, stocks were Americans' second most popular choice for long-term investments, behind only real estate, according to a recent Bankrate survey. Or you can do a little of everything, diversifying your portfolio so that it tends to do well in almost any investment environment. 1. Growth stocks. Overview. In the world of stock investing, growth stocks are the Ferraris. They promise high growth and along with it, high investment returns. Growth stocks are often tech companies, but they don't have to be. They generally plow all their profits back into the business. So they rarely pay out a dividend, at least not until their growth slows. Who are they good for? If you're going to buy individual growth stocks, you'll want to analyze the company carefully, and that can take a lot of time. And because of the volatility in growth stocks, you'll want to have a high risk tolerance or commit to holding the stocks for at least 3 to 5 years. Risks. Growth stocks can be risky because often investors will pay a lot for the stock relative to the company's earnings. So when a bear market or a recession arrives, these stocks can lose a lot of value very quickly. It's like their sudden popularity disappears in an instant. However, growth stocks have been some of the best performers over time. Rewards. The world's biggest companies, the Alphabets and the Amazons, have been high growth companies. So the reward is potentially limitless if you can find the right company. Where to get them? You can purchase them at any online broker that offers stock trading. 2. Stock funds. Overview. A stock fund contains a collection of stocks, often unified by a specific theme or categorization, such as American stocks or large stocks. The fund company charges a fee for this product, but it can be very low. Who are they good for? If you're not quite up for spending the time and effort analyzing individual stocks, then a stock fund, either an ETF or a mutual fund, can be a great option. A stock fund is an excellent choice for an investor who wants to be more aggressive by using stocks but doesn't have the time or desire to make investing a full-time hobby. Risks. A stock fund is less risky than buying individual positions and less work, too. But it can still move quite a bit in any given year, perhaps losing as much as 30% or even gaining 30% in some of its more extreme years. If you buy a fund that's not broadly diversified, for example, a fund based on one industry, be aware that your fund will be less diversified than one based on a broad index such as the S&P 500. So if you purchased a fund based on the chemicals industry, it may have a lot of exposure to oil prices. If oil prices rise, then it's likely that many of the stocks in the fund could take a hit. 3. Bond funds. Overview. A bond fund, either as a mutual fund or bond ETF, contains many bonds from a variety of issuers. Bond funds are typically categorized by the type of bond in the fund, the bond's duration, its riskiness, the issuer, corporate, municipality or federal government, and other factors. When a company or government issues a bond, it agrees to pay the bond's owner a set amount of interest annually. At the end of the bond's term, the issuer repays the principal amount of the bond, and the bond is redeemed. Who are they good for? Bond funds are good for investors who want a diversified portfolio of bonds without having to analyze and buy individual bonds. They're also good for individual investors who don't have enough money to buy a single bond, which usually costs around $1,000, and bond ETFs can often be purchased for less than $100. Risks. While bonds can fluctuate, a bond fund will remain relatively stable, though it may move in response to movements in the prevailing interest rate. 4. Dividend stocks. Overview. Where growth stocks are the sports cars of the stock world, dividend stocks are sedans. They can achieve solid returns, but they're unlikely to speed higher as fast as growth stocks. A dividend stock is simply one that pays a dividend, a regular cash payout. Many stocks offer a dividend, but they're more typically found among older, more mature companies that have a lesser need for their cash. Dividend stocks are popular among older investors because they produce a regular income. And the best stocks grow that dividend over time. So you can earn more than you would with the fixed payout of a bond. REITs are one popular form of dividend stock. 5. Value stocks. Overview. When the market runs up a lot, valuations on many stocks have been stretched. When that happens, many investors turn to value stocks as a way to be more defensive and still potentially earn attractive returns. Value stocks are those that are cheaper on certain valuation metrics such as a price-earnings ratio, a measure of how much investors are paying for every dollar of earnings. Value stocks are contrasted against growth stocks, which tend to grow faster and where valuations are higher. Who are they good for? Value stocks might be an attractive option because they tend to do well when interest rates are rising. And the Federal Reserve has been raising interest rates at a furious clip recently. Risks. Value stocks often have less downside. So if the market falls, they tend to fall less. And if the market rises, they can still rise, too. 7. Real estate. Overview. In many ways, real estate is the prototypical long-term investment. It takes a good bit of money to get started. The commissions are quite high, and the returns often come from holding an asset for a long time, and rarely over just a few years. Investing in real estate can be an attractive strategy, in part because you can borrow the bank's money for most of the investment and then pay it back over time. Who are they good for? For those who want to be their own boss, owning a property gives them that opportunity. And there are numerous tax laws that benefit owners of property especially. That said, while real estate is often considered a passive investment, you may have to do quite a bit of active management if you're renting the property. Risks. Anytime you're borrowing significant amounts of money, you're putting extra stress on an investment turning out well. But even if you buy real estate with all cash, you'll have a lot of money tied up in one asset. And that lack of diversification can create problems if something happens to the asset. And even if you don't have a tenant for the property, you'll need to keep paying the mortgage and other maintenance costs out of your own pocket. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.